Hi class, welcome to lecture 4.2. Now this is really just a side lecture on the efficient market hypothesis, and the efficient market hypothesis was briefly discussed in chapter 1, but it's a very important topic, so I thought I'd take a moment to talk to you about it. And from listening to this lecture, you should hopefully get one, maybe two conceptual questions right on exam 4. Now, as far as an outline for this lecture, I'm going to discuss the definition of the efficient market hypothesis, talk about the three different types, which are the weak form, the semi-strong form, and the strong form. And then I'm going to talk about a couple things that might violate the efficient market hypothesis, specifically the semi-efficient market hypothesis and anomalies. So let's get straight to the definition. Here I'll just read it for you. It's the theory supporting the notion that market prices are in fact fair. Now, what does fair mean? Well, fair is pretty much comes down to two different concepts. One is a matter of time. Can you get that information to me quickly? And one is about accuracy. Can I get accurate, true information about the stocks? And then, some people can argue about risk and return or time value money. There are those out there that believe that this is the most important concept in finance, which is obviously why I decided to make a small side lecture for you guys. So before I go any further, let me talk about a few things. Capital market theory is going to really develop from this notion that people like return and they pretty much don't like risk. Now, theoretically, everybody wants to get the highest return they can for the lowest risk involved. Over time, people developed capital markets where they could trade securities that they felt had a decent, risk versus return trade-off, and hopefully we're trading these securities with, a range of liquidity. Examples of capital markets that we've seen are the New York Stock Exchange. There used to be the American Stock Exchange. We now have NASDAQ. The New York Stock Exchange is by far the biggest. And then we have NASDAQ, which is by far the second biggest. And that stands for the National Automated System. Well, let me re-say that. I got off on the wrong acronym meaning there. It stands for National Association of Securities Dealers Automated Quotations. And you don't really need to know that at all. Obviously, I don't even remember it perfectly sometimes. But it's the second biggest. And then every single other country that is, relevant in today's economy will have, their own stock exchange. So there's going to be the London Stock Exchange. There's going to be a stock exchange in Toronto. China's got a couple different big stock exchanges. The Euro has a stock exchange. So there's going to be a lot of stock exchanges out there. But it's safe to say the New York Stock Exchange is going to stay the biggest for quite some time. Some other big important places that you can go to trade: the Chicago Board of Trade, the Chicago Board Options Exchange. Options, as far as different derivative products, futures, forwards, that kind of stuff, swaps. That's all can happen just about in any of these major exchanges. But it's really kind of rooted itself in Chicago. So that's kind of maybe the center for options throughout the world. Regardless of which market though you're looking at, you want it to be efficient, right? It needs to serve some kind of an economic function where it facilitates the transfer of money from savers to borrowers. Examples of this could be, just regular mortgages for houses, treasury bonds, corporate stocks, corporate bond, you name it. There's a lot of different examples you could come up with. You also want that market to have a continuous pricing function, which basically just means it keeps the prices up to date. And most investors like investments that trade quite a bit because that means there's liquidity. So an investor is not as worried about an investment in a Apple stock or Walmart stock or something like that as they may be in a real estate purchase where it might be much harder to sell that real estate. Along with this idea of liquidity, efficient markets are also going to have a fair price function. This is going to remove that fear of buying or selling at an unreasonable price. And really what's involved here is that, the more participants you get involved, the more likely you are to think that you're getting a fair price. So if you go out and get a bid on selling your car and you get it from one person, you don't know whether or not that's a fair price. But if 15 people give you bids on selling your car, then you've got a pretty good idea of what a fair price is. So the more participants, the better. This is how a lot of places like eBay became popular because you can get up on there and get a whole lot of people interested in what you're buying, what you might be selling. You can also find things that people that are selling themselves that you might want to buy, and this might be better than trying to do an estate sale or set up a garage sale where you're going to pretty much have to take the price from the person that comes by. So a good question on exam would be, what are some major functions of an efficient market hypothesis? And you would want to know that there's an economic function, there's a continuous pricing function, and there's a fair price function. There's also two different types of efficiency we're talking about here as well. We're talking, one is operational efficiency, right? So we're talking functionality in terms of execution and accuracy. So how do things work? That's really what we're interested here. What is the accuracy of orders getting filled? What is the amount of time it takes for an order to get filled? Those kind of questions. Informational efficiency, the other type, is how quickly and accurately the market reacts to new information. So once again, we're talking about accuracy and timing, which I've mentioned a couple times here. Hint, hint, maybe on an exam. But what is important in this case is new information. How does the market react to new information? And so this will relate directly to the efficient market hypothesis, because in a lot of ways the efficient market hypothesis says that the markets should react almost instantaneously to this new information. However, a market probably can never be 100% efficient, and so really what I guess some of today's lecture about is what degree of efficiency do we have in today's markets? So we'll start with what's known as the weak form of the efficient market hypothesis, and it pretty much states that there's just no way that you can predict future stock prices based on any information that you've gotten from the past. Now, if any of you have ever heard of day traders, these are people that will often look for patterns, or sometimes they're called chartists, and they're charting patterns within past information, such as price movements or volume changes. And what they're really looking for is a pattern that they think that they could maybe buy low, sell high, or catch some kind of momentum swing or whatnot, and make money off of a stock. Well, there are going to be three different types of the efficient market hypothesis, and all of them say that you can't do that, right? That you can't use that past information. So even in the weakest form of the efficient market hypothesis, basically all technical analysis is useless. Let me give you an example. Which one of the following stocks would you buy? Would you buy stock A? Would you buy stock B? Now, some of you might say, well, stock A was up high and it's dropped a little bit, so now this might be a buying opportunity. And others, you might say, I wouldn't want to buy anything that's trending down. And so some of you might say, let's buy stock B. It looks like it has some momentum. And others might say, well, it's gone up too far in value and I think it might be now overpriced. All of that kind of information is pretty much worthless as far as the efficient market hypothesis is concerned, even in the weakest form, the weak form, because you see how stock A and stock B are currently at the exact same point. Well, they basically are the exact same value, and you don't have any idea which one is a better buy based off of only using their past pricing information. In fact, you could have a stock C there that went way up, way down, way up, way down, and just a whole bunch of squiggly marks and everything, and ended up at that exact same point as stock A and stock B, and still you wouldn't know which is a better buy between stock A, stock B, and stock C. So once again, according to the weak form of the efficient market hypothesis, neither one of those stocks is a better buy. And why? Because all past information has already been included or reflected in the current stock price. So this brings us to the next form, which is the semi-strong form. And the semi-strong form has probably the most support of academics or hard research support. And however, it's not one that's really widely accepted by a lot of investors in the industry because, frankly, it's saying that what a lot of investors do is not worth a lot of time. So let's take a look. The semi-strong form is going to say that pretty much all publicly available information, that you can get is going to already be reflected in stock prices. So this would include, anything you could look up online at Yahoo Finance or on Morningstar or using a Bloomberg terminal. Basically, any information you can get, if it's out there for the public, it's already included. So there's no point in going and looking up their 10Ks and going through there and trying to find out information or trying to search news stories to see if they may get sued or whatnot. If it's out there in the public arena, then that information has already been priced into the stocks. Once again, that doesn't sit well with a lot of investors because that would say that a lot of what they do is just a waste of time. So once again, let me stress that academic research supports the semi-strong form more than any of the others. And it does it by investigating various corporate announcements such as stock splits, cash dividends, stock dividends, and the market pretty much nails these as soon as they are announced and as soon as they happen. Um, so you're seldom going to beat the market just using public news. Maybe even a stronger bullet point is from Burton Malkiel, which points out that two-thirds of professionally managed portfolios are consistently beaten by a low-cost index fund. What does that mean? That means that if you go out there and look at all these mutual funds that most people put their money into for their 401ks or IRAs, whatnot, you could probably put your money in just like a low-cost ETF or index fund and beat most of those. Why? Because they have some costs that are in their management fees and trading fees and things of that nature that make it a little bit harder for them to keep up with just what the market's doing. So the average investor is based on the semi-strong form should not beat the market. So once again, as long as you're in a well-diversified portfolio, uh, that you pretty much reduce the risk as much as you can, and you're not going to beat the return on average of the market, at least under the semi-strong form, considering that you're an average investor. Now, this is where some students say, well, why even learn all this information if it's not useful? Well, you have to also remember that there are above average investors, and that's always something that you can strive to be. And there are different people that don't necessarily believe in the semi-strong form, at least that there are certain caveats that might violate it, which we'll talk about later on in this lecture. And then finally, you come to the strong form, which is basically says you can't use any information, right? So you can't use any past information on price movement or volume. You can't use any information in the public arena. And it goes even further and says you can't even use any private insider information. Now, I'd kind of, throw up a red flag here and say this is where I don't really believe. In the strong form, I think it goes too far, and one of the reasons for this is because if insider information didn't make people money, they wouldn't do it, right? Because there's a strong disincentive to doing it because you might go to jail. Look at Martha Stewart. She didn't necessarily go to jail for insider trading. She went to jail for lying, but it was about insider trading, and there's a lot of evidence out there that suggests that insider trading does make you some money. For example, politicians with no financial experience tend to outperform average investors. Why? Because they have insider information. And in a lot of cases, since they're a public employee, they can do this legally. Also, let me ask you this. Could a corporation use insider information? Is it legal? Yes. So a company can use their own inside information to make money. For example, let's say a an airline company, okay, like maybe Delta, and let's say another airline company, let's say like JetBlue. Uh, let's say JetBlue wants to go to Atlanta and open up a hub there. Well, that's Delta territory, right? So not only if they know they're going to do this and they're going to be successful in doing it, it might hurt Delta. So before they do it, they may want to short Delta stock, right? So that could make them a lot of money. But if they thought, if the stock for Delta actually did go down. But could a CEO do that? Well, that's where you get into the legality there. A company can do it, but the CEO and the people higher up in the companies are not supposed to be using insider information to make money. So, long story short, I'm not a big fan of the strong form. I think that there's some obvious ways to disprove it, but it is one of the three major forms for the efficient market hypothesis. So, let's go over a summary. Okay, just to, if I was going to ask a question, it's probably going to be a big picture question. And so, what information is already included in current stock prices? So, I made this table for you. It shows the three different forms. It shows you that the weak form considers all past information, uh, but it doesn't say that public information or private information is already priced into current stocks. Semi-strong form goes a step further. It adds the public information into current stock prices, and then the strong form says that all information is basically locked into the current stock prices. Now, another way of looking at this is to ask the question, what information can an investor use to gain a competitive advantage? So now I created this table, and it's the exact same table except for the fact that I just basically changed all the no's to yeses and all the yeses to no's, right? So in the weak form, can an investor take advantage of past information? No. But could they take advantage of public and private information? Sure. In the semi-strong form, the only information they can take advantage of is private information, and in the strong form, they can't take advantage of any information. So I think I could ask that question from either angle, and you should be able to get that right. Now, we're going to wrap this up with two quick slides about ways that the market might not be efficient, maybe ways that you could possibly see that the market violates the efficient market hypothesis. One of those, and one of my favorites, is the semi-efficient market hypothesis. And this says that, in a lot of ways the market is efficient, especially if you're talking about really big stocks or, stocks for really big companies. However, there is a lot of companies that aren't as followed as frequently. Walmart gets a ton of press. Apple's going to get a ton of press. A lot of the stocks in the S&P 500, especially in the consumer discretionary sector, these stocks are going to get a lot of press. So they're probably priced pretty efficiently. But if you look at some more mid cap and especially the small cap stocks, you're getting into areas where maybe these companies are covered less often than the large cap stocks. Then you can go even further into strange areas or stranger areas of the market, like emerging markets in countries that don't have the same kind of resources or media sources to follow companies. So those markets might be more inefficient. You could also argue that really micro cap stocks or penny stocks are pretty much not covered at all. So basically, I think what you will see here is that the market may be tiered and that there may be somewhat of a neglected firm effect going on, meaning that some companies are neglected whereas other companies get all the attention. And if you were really wanting to maybe make money and you believed in the efficient market hypothesis, but you also believed in the semi-efficient market hypothesis, you might want to spend your time analyzing stocks that not everybody's looking at, because maybe you could find a hidden nugget, so to speak, or maybe you could find an opportunity that the rest of the market really hasn't paid much attention to. In other words, everything you're learning in finance, in the rest of your finance classes and whatnot, could be very useful as long as you find a niche where you can operate and get a really good return for the amount of risk involved. Something else that you could take advantage of are anomalies, and anomalies run the gambit from research proving them to just kind of superstition. I like to joke with some of my students sometimes that there's all kinds of anomalies out there. Some based on who wins the Super Bowl, down to whether or not the women's skirt lines are short or whether or not they're long. And for example, with that, the theory goes that as women's hemline, so to speak, gets longer, that they get more conservative, which might indicate that the market's not doing too well. But as the market does better and better, that women feel more comfortable and they wear shorter skirts. This is somewhat of a sexist anomaly to even discuss. Is there any truth behind it? Absolutely not. And then I would argue that even if there was any truth to it, you would have to consider it more of a lag effect, right? That this would be, changes in the way men or women might dress would probably be more of an reaction to what's going on in the market instead of a predictor of what might happen in the market. Other crazy anomalies out there, there's the skyscraper curse, which basically means whichever country currently has the highest skyscraper has just peaked, and so you wouldn't want to be invested in that country any longer. Um, I can see where there's some logic to that, but there's no proof that actually works that way. I think it's a much better use of your time to actually consider those anomalies that have been proven from a research standpoint. You don't have to have these memorized for the exam. I'm not going to ask a question on anomalies, but just in case you're interested, I would research the following anomalies. There's one called the low PE effect, which is your price to earnings, and that's probably one that has a lot of research behind it, especially considering that PEs or price to earning ratios, which you've learned in for your first exam, are a good way to measure whether or not you think a company has any growth potential or whether it might be over or undervalued. There's also one called the low priced stocks or low price stock effect. And this kind of says that some stocks really trade better if they're in kind of a lower optimal range, somewhere maybe in that $20 to $50 range. I know that you'll see a lot of stocks as they get up into the near $1,000 or whatnot per price. They may do a stock split. Netflix recently, so I'm doing this in 2015, right? Just had their major stock split, and they went from somewhere in around $700 down to $100, and so that was a 7-for-1 stock split, and that got them closer to what they thought was their optimum trading range. So, but that whole anomaly goes by the theory that stocks that are lower in price are more appealing to the average investor because they may seem somewhat more affordable. Also, moving from let's say $10 to $15 would be a 50% rate of return, but moving from $1,000 to $1,500 may not seem as likely in some investors' minds, even though that would be what you'd need to do to get the same amount as far as a percentage return. Others include the small firm effect, which just basically says small cap firms over time might do a little bit better. We've kind of talked about that. Maybe there's a little bit of a semi-efficient market hypothesis playing it there. You could also throw in the neglected firm effect if that same idea, which we've kind of talked about. And then some people think also that the market just overreacts sometimes. So market overreaction has tended to be somewhat of an anomaly that people like to study in the markets. And there's also a few timing anomalies, such as the January effect, which is that small cap companies tend to do a little bit better in January, especially in those first few days. There's a lot of issues for that. If you want to know more about that, take it in one of the investments class. Even the day of the week or even the end of the month, there are different anomalies for those as well. So the main point here is that there's a lot of room for finding potential strategies that might help you overcome an efficient market, to where you might find a niche where the market is semi-efficient, or you might find an anomaly that goes against market efficiency. So, and you've got a chance. You got a fighting chance, and you're definitely going to have a better chance of beating the market if you're an above average investor. So, pay attention here. If you've liked some of this lecture, that might be an indication that you really have a mind for investments and that you might want to pursue a finance major with the investment track. And if you'd like to talk to me more about that, please let me know. I've got a lot of exciting opportunities that I could talk to you about, such as the Smile Fund that we have here on campus. We also not only have a finance club, we have a trading club. We have some opportunities to do an investment challenge through the CFA Society. We also have opportunities to take students to New York. So if this lecture sounds like something that you may want to think about as a career field, let me know. Set up an appointment with me. I'd love to talk to you more and maybe even give you a reading list so that you can go ahead and start exploring the wonderful area of investments. So, this concludes lecture 4.2 on the efficient market hypothesis.